let's turn our attention right over to the energy sector. Looking at Occidental Petroleum, the shares are rising after posting a nearly $5 billion profit in the first quarter. And let's break down this report with a pro, and that's David Deckelbaum, analyst over at Cowen. Thank you so much for being with us. So tell me your thoughts on the group here. I have some of the names that you like in particular, but overall, is it a group thing that's doing well, or is it a pick and choose here? Because Occidental came out with some good numbers.
Yeah, no, it's a great point. Occidental came out with some strong numbers. Certainly, they beat cash flow by about 1%. They didn't really change much in terms of their guidance. They're experiencing record margins right now on the chemical side, and then obviously flowing through the benefit of extremely high commodity pricing for both gas and oil right now. I think the key for the E&P sector is really what investors are viewing, I think, as a play against inflation. You've obviously seen robust commodity prices. I think in general, it's just a broader macro market backdrop right now. There is definitely a preference amongst our clients that are looking at value versus growth right now. And E&Ps, for the most part, on average, our universe is trading at almost a 20% free cash yield in 2022 and about 23% in 23. These companies are all giving back this capital to shareholders right now, and I think that's really the pitch. That's the value that these companies are creating.
So what's interesting is how this group has completely bucked the trend of the markets, because we keep saying like there's nowhere to hide. Everywhere you look, there's been some selling, but a name like Occidental really has had a beautiful chart. In fact, at or near these 52-week highs. You have a few other names that you like, including Diamondback Energy. Tell me a little bit about that one.
Yeah, I mean, I think like with all of these, if you look at these charts, these names all came from being probably the most hated names in the entire market. If you look at energy weighting as a percentage of the S&P, we bottomed out sub 2%, during the COVID crisis. Now you're closer to 4%. Some of that's momentum building. But to your point, like these companies, they've all recapitalized. They stopped growing. They focused on generating massive amounts of free cash flow. At Cowen, we try to focus on names that can earn an inordinately high percentage of free cash flow relative to their enterprise value through 2025 and 2030. We'd point out that most of our universe right now, they're going to earn over 100% of their enterprise value on average by 2030. Meaning, many of these companies have huge opportunities to return massive amounts of capital to shareholders, potentially go private. It's just created this perfect storm of events with high commodity pricing. Leverage is now going to be in a net cash position for the group going into 23. And again, you're seeing these robust free cash return profiles out there. One of the reasons why we like names like Diamondback and Pioneer Natural Resources is that they have a highly visible free cash yield north of 20%, and they're paying out more than 50% of that capital immediately to shareholders. Even Pioneer last quarter, they paid out effectively a 12% capital yield on your dollars today, even after these names have run between 50 and 100%. And Occidental obviously has been the best performing name year to date. Out of our coverage, it's up over 100%. The rest of our coverage has averaged about 40% year to date.
Right. And so when I look at these names here, overall, it's interesting because the idea is that we're going to have more demand, I guess, in the future. I mean, the EIA has come out and said that the U.S. is likely to have the most production ever. I mean, this doesn't happen just willy-nilly. I know we have the Russia story and less coming from there, but ultimately, is this because we're going to see demand?
Look, I think a lot of this has really just been the benefit of a reopening trade. The U.S. and really the rest of the world has been underinvesting in energy for perhaps a decade. The U.S. perhaps more so in the last 4 to 5 years. And I think that dynamic is really just creating, again, like this perfect storm where it's very difficult to have supply responding as quickly as the demand has been catching up. You've seen OPEC member nations increasing supply more recently. I think our view at Cowen is that you're going to continue to see, a fairly minimal deficit in the back half of this year as demand continues to grow and rebounds. And you're still not at peak demand levels. But as we go into 2023 and 24, there's going to be adequate supply in effect where we would be modestly oversupplied relative to demand. I do think the interesting point about the EIA looking for growth out of the United States is we just don't see the capacity for the U.S. to grow right now. And I think you're seeing that refrain from all of the public producers out there today, which makes it even more compelling, I think, as an investment category right now is, these companies couldn't spend capital dollars if they wanted to.
Yeah, just quickly on the buyback, the CFO over at Occidental extending the buyback program. Is this the right thing to do here for Occidental? And just some of the other big names like Exxon and Chevron that people love to talk about, if you had any thoughts about those.
Sure. I don't specifically cover Exxon and Chevron, but I think what you're seeing and what we've wrote about historically is you're seeing the independent oil and gas producers acting like majors, right? They're giving back tremendous amounts of capital. They're instituting these buyback programs. You asked, is it the right thing? I mean, these names, again, are going to be in net cash positions. You have a choice of either do you redeploy that capital and grow production, or you distribute a certain amount to shareholders, or do you build cash in your balance sheet? And I think that the answer is certainly with what investors want is better governance, better social standards. And I think that means that, yes, it's certainly the better thing to do to put a buyback in place. Occidental has a $3 billion buyback program that they're probably going to start tapping into in the second quarter here after focusing on deleveraging for the last 3 years. That's about 5% of their market cap right now. We see several of our names like Pioneer that has a 7% of their market cap buyback. Diamondback has close to an 8% of their market cap buyback program. I think all of these show, one, that there's natural support for these stocks, but two, this is what investors want right now.
Interesting. David Deckelbaum, thank you. Analyst over at Cowen. Thank you, David.
Thank you.